Welcome to this week's video, where I'll be talking about what I believe individual investors need to know to make their investment decisions over the next 5 to 10 business days. This week, we're going to be talking about interest rates. Interest rates have moved a lot higher. How are they affecting the stock market? How do they continue to affect the stock market? And how will they start to affect borrowing costs, mortgages, lines of credit? We also want to talk about oil. Over the last little while, the oil sector has been one of the best performing sectors in the market. And it's something that I've been receiving a lot of questions on. Why don't I believe in oil? Where do I think the price of oil is going? And lastly, this whole idea of what goes up must come down. A lot of individual investors, clients of mine, have been saying, Alan, markets have been going up for so long. At some point, they must come down. Won't they? So we'll talk a bit about that as well. Interest rates, they're continuously moving higher. Here in our country, the 10-year government bond rate right now sits at 1.55%, up from about 0.5% where it was just a short time ago. In the United States, interest rates on their 10-year government bond have gone up to over 1.6%. Again, a short while ago, these rates were down in the 0.3, 0.4% range. Now, for a lot of individual investors are saying, well, how does that affect me? Mortgage rates, lines of credit, these are things that actually feed off of these government bond rates. So what we're already starting to see are fixed mortgage rates moving higher. Many people now are starting to look at variable rates because they're seeing their fixed mortgage rates move higher. The gap between variable rates and fixed rates is definitely widening. At the same time, higher interest rates usually means trouble for the stock market. But when you move from such a low rate to 1.5%, which historically is not that high, the market can withstand this. I think the fear in the market has been over the last month or so, how fast these rates have been moving and how much higher can they climb. Is the market trying to tell us that inflation is coming down the road? We just saw the United States pass a huge stimulus bill, $1.9 trillion. Many people believe this is going to spur on inflation, and the market is nervous, and we're starting to see interest rates move higher. I've talked about this many times over the last few years, saying the Bank of Canada and the Federal Reserve that it would be impossible for them to say, we won't change rates until 2023. I was right. I think they're going to start talking about rates before the end of this year. And I think the market is a little bit fearful of that. And that's why you're seeing a sell-off in certain areas of the stock market. And it will continue to be a bumpy ride going forward. Price of oil has been going up steadily over the past many months now. It's probably been about 6 months. A lot of Canadian investors that have invested in oil for quite some time are finally reaping the rewards of a higher oil price. I've always maintained that the price of oil is something that I'm not too bullish on. I think it's a manipulated commodity. I think the price of oil is determined by a selected few countries, the United States, Saudi Arabia, some of the other OPEC nations. And I think as long as we see these countries dominate with respect to the production of energy or oil, price of oil can remain high. If these countries decide to produce more, you'll see the price of oil start to pull back. So it is something that it's very hard for me to get behind. Plus, when you look out into the future, you see a lot of alternative forms of energy, whether it's battery power, solar power, wind power. So it's not something I see as a sustainable trend for the long term. In the short term, we could see it move a little bit higher, although I do think we are at the top at this point. So can you own oil for a diversified portfolio? Perhaps for a small percentage, but I definitely wouldn't make it a huge part of any portfolio that I'm designing right now. A lot of conversations I've been having with clients, investors in general, they're talking to me and saying, Alan, market's going up so much for so long, so high. What goes up must come down. Isn't that the case? And yes, I guess if you look at things from an overall or general perspective, yes, the markets do revert back to their averages, their long-term averages. But keep in mind this, markets, as we know, always seem to move higher. There will be points in time where markets correct. We just saw a recent correction in the NASDAQ or the tech-weighted index. We saw the market fall more than 10%. It was so quick, if you blinked, you probably would have missed it. What we do know is this, that bull markets last or good markets last for a lot longer than bad markets. Bad markets correct very sharply. You'll see the market fall very rapidly in a very short period of time, whereas markets gain over the long period. So the good times last longer, the bad times are shorter. We like to say in this business, the markets, they take the elevator on the way down, but the stairs on the way up. And so will we see a correction this year, or further correction, or another correction? Absolutely, it's possible. But at the end of the year, I believe that if you are an investor today in good quality investments, the markets by the end of this year will be a lot higher than they are today.